Thank you so much, everyone. And it is a big pleasure to be here today. This is the last session of the day, but we have a really interesting session ahead with really an exceptional lineup of speakers. In this session, the main goal is to really cover the role that emerging technologies will play in shaping the future of the voluntary carbon market. I will kick off first with very brief introduction on the state of the VCM, and then we'll hear from our amazing lineup of speakers, and then we'll finalize with a 30-minute panel where we'll continue to deep dive into some of the solutions that our panelists will present. So let's discuss quickly the state of the VCM. The voluntary carbon market is basically this mechanism that companies, organizations, but also individuals use to channel funding and money to projects that do good, projects that avoid, reduce, or remove emissions from the atmosphere. By purchasing carbon credits, this is the mechanism that companies and organizations follow to really channel money and funding to these projects. The charts that you see here really represent where we are at today in the VCM. And as you can see, not much has really changed in the last 5 years. Issuances which speak about supply and retirements which speak about demand have been fairly stable. As you can see, most of the credits brought to market come really from two main credit types, which are avoided deforestation or REDD+ credits, but also renewable energy projects. Something that it is important also to note in these charts is that the market has been very largely oversupplied. What this has meant is that most of the credits have been actually sold at very low prices because supply has been consistently above demand. Something that I also like to remember myself when looking at these charts is that even though the VCM has got a lot of criticism and a lot of scrutiny, if we look at yearly issuances, for example, the volumes here are less than 1% of global emissions. So the VCM is still fairly small today. But as I was saying, a lot of scrutiny has gone to the VCM. But really here it is important to remember that not all projects are equal and not all credits are created equal. Most of the criticism has really gone to avoidance credits. And that is because these credit types rely on calculating counterfactuals. So counterfactuals are what would have happened in the real world if the project would have not occurred. So let's imagine, for example, an avoided deforestation project. If the real deforestation rate without the project is actually lower than what the project is claiming, what this leads is that the project ends up over-crediting, so issuing more credits than what it should. So really overstating the climate impact that it has. This doesn't really happen with carbon removal credits, and that is because carbon removal is more active. It is easier to measure the CO2 that we remove from the atmosphere. That being said, bad quality CDR projects do exist today in the market. CDR, however, is a very small part of the market today, around 5%, and most of the credits are still avoidance and reduction projects. Something that it is important to note also when thinking about CDR is that even if the market is fairly small, and even if the whole VCM hasn't really grown that much in the last 5 years, CDR, as a very small subset of the VCM, has actually grown. 2024, for example, was a yearly record of retirements for nature-based removals, and also a yearly record of retirements for high durability credits. That being said, most of the market is still lower durability credits, nature-based solutions that can store the CO2 for decades, and only 3% are higher durability credits that can store the CO2 for centuries to millennia. So demand has grown, but it is also important that we think about where it will go in the next 5 years. And what we think here at Carbon Direct is that demand could roughly grow by roughly 5 times the current levels. And the main driver for this is big tech and financial institutions which have 2030 neutralization targets and will need million tons of CO2 removal to really neutralize the emissions that they have in their scope 1 and 2, but most importantly in their scope 3. So these are the companies, for example, like Microsoft, Google, but also large financial institutions like JP Morgan Chase. And to meet this growing demand, what these companies are doing, you saw that slide in Julio's presentation, is sign forward offtake agreements. So what these agreements mean is that these companies secure access to future supply at a known price, which is important. And this known price reduces the exposure to spot market price volatility. Most importantly, securing offtakes for projects really means that these projects get bankable if the contract is structured correctly so that that supply can come online. The clear winner here has been higher durability projects, big growth in the last 2-3 years. And within higher durability projects, biomass-based pathways that can be traditional bags, but also pulp and paper CCS, ethanol CCS, bio-oil, bioslurry injection have really grown dramatically in the last couple of years. To meet that growing demand, a big ecosystem of CDR startups has also emerged. There are more than 500 companies now trying to develop and supply this credit to the market to really meet the growing demand that we'll see in the next years. Think solutions from forestry, soils, but also higher durability, more novel, like direct air capture, enhanced rock weathering, biochar, solutions that we have been discussing throughout the day. And it is really important that we get at least some of these companies to scale, because we do need the VCM to scale dramatically if we want to meet our long-term climate goals. All IPCC scenarios that limit global warming below 2 degrees, or most of them require large-scale CDR deployment. As Julio said, between 5 to 10 gigatons of CO2 need to be removed per year by 2050. So we do need some of these companies to scale, the VCM to grow, to really meet our long-term climate goals.